Welcome to Factful Finance, where we break down complex financial concepts and make them easy to understand and actionable. Let's start with a question that many investors overlook. What are the tax implications of investing, specifically when it comes to capital gains? If you've ever wondered how your investments are taxed when they grow, this video is for you. Before we dive into the details, here's an important point. The information in this video is for educational purposes only. We're not offering personalized advice, so it's always a good idea to consult a professional for guidance tailored to your specific situation. Now let's talk about capital gains. Simply put, capital gains are the profits you make from selling an investment, whether it's stocks, bonds, real estate, or other assets, at a higher price than you paid for it. But here's where things get tricky. Not all capital gains are treated the same way by the IRS. Let's break it down. There are two types of capital gains, short-term and long-term. If you sell an investment that you've held for 1 year or less, you'll face short-term capital gains tax. This is taxed at the same rate as your ordinary income, which means it could be as high as 37%, depending on your tax bracket. Now, if you hold the investment for more than a year, it qualifies for long-term capital gains tax, which is taxed at a lower rate. The exact rate depends on your income level, but can range from 0% to 20%. Yes, you heard that right. If you're in the right tax bracket, you could be paying as little as 0% on your long-term capital gains. This is one reason why some investors prefer to hold their investments for the long haul. It's a smart tax-saving strategy. Let's look at a real-world example. Imagine Sophia has invested in tech stocks, buying $10,000 worth a few years ago. Over time, the value of her stocks grows, and she decides to sell when they're worth $15,000. This means Sophia has a $5,000 capital gain. Since she's held the stocks for more than a year, she qualifies for the long-term capital gains tax rate. If she falls into the 15% tax bracket for long-term gains, her tax bill would be $750, instead of paying a higher rate like 25% or more that she'd pay if the stocks were sold within a year. Another thing to keep in mind is the capital gains tax exemption for primary residences. If you sell your home and meet certain conditions, you can exclude up to $250,000, $500,000 for married couples, of the capital gain from taxes. This is a huge benefit that many homeowners don't realize, so it's definitely worth considering if you're thinking about selling your property. But not all capital gains are taxed equally. For example, collectibles like artwork, coins, or vintage cars are subject to a maximum tax rate of 28%, which is higher than the typical long-term capital gains rate. So if you've invested in these types of assets, be sure to check the rules for your specific case. Now let's talk strategy. Tax loss harvesting is one effective way to manage your capital gains tax bill. This involves selling investments that have lost value in order to offset the capital gains you've made from other investments. Let's say Liam has a $5,000 capital gain from selling a stock, but also has a $3,000 loss from another investment. By selling the losing investment, he can offset $3,000 of his gain, reducing his taxable capital gains to just $2,000. This strategy is especially valuable in years where your portfolio has fluctuated in value. And don't forget about the net investment income tax, NIIT. This is an additional 3.8% tax on investment income, including capital gains, for individuals with a high income. If you're a high earner, this could apply to your situation, adding an extra layer of tax. So, what should you take away from all this? Here's a quick recap. Understanding capital gains tax is crucial for any investor. The more you know, the better you can plan your investment strategy to minimize taxes and maximize your returns. Remember, holding onto investments for longer periods can save you money on taxes, and strategies like tax loss harvesting can help you lower your tax bill. But always make sure to consult a tax professional who can tailor these strategies to your personal financial situation. What's the first step you'll take to better manage the tax implications of your investments? Let us know in the comments. And if you found this video useful, why not subscribe to our channel so you don't miss out on future tips that could help you reach your financial goals? If you like what we do here at Factful Finance, we think you'll find the next video on screen interesting and helpful. Thanks for watching, and we'll see you in the next video.